Hello everyone, welcome back to Stock Valley. It's October 2025, and the world economy is once again standing at crossroads. Debt in Washington is rising faster than ever. The Federal Reserve is facing one of its toughest choices in decades, and over the Asia, China's slowdown is starting to shake foundation of global trade. So today, we are going to break down these three major stories. What's happening, why it matters, and most importantly, what it could mean for investors in months ahead. Let's get started. The US debt crisis, running out of money again. Let's begin in Washington, D.C. The United States nation's debt has officially surpassed $36 trillion. That number alone might not shock anyone anymore, but what's shocking is how fast it's growing. Just 5 years ago, America's debt was around $27 trillion. Since then, the government has added nearly $9 trillion more. That's about $5 billion every single day. Now, here's where it gets serious. Interest payments on that debt are exploding. In 2025, the US government is expected to spend more than $1.2 trillion just cover interest, more than it spent on the entire military. And unlike defense spending, those interest payments don't buy anything, just keep the lights on. Treasury Secretary Janet Yellen has already warned Congress that the government could face another shutdown in November if the new budget deal isn't passed. Republicans are calling the major spending cuts, especially in social programs and climate invitations, while Democrats argue that cutting too deep could push economy into a slowdown. The result, a political standoff, and once again, the global markets are watching Washington, wondering if America is might run out of money for the second time in 2 years. Meanwhile, bond yields have surged over 5.1 percentage, their highest level in more than 2 decades. That means investors are demanding higher return to hold US debts, a clear signal that inflation is fading. So what happens if this continues? Higher yields push mortgage rates up, business pay more to borrow, and the stock market starting to feel the pressure. Some analysts even believe the US could be entering what they called as debt spiral, where rising debt causes higher interest and a higher interest creates even more debt. That's not a cycle you want to be trapped in. And the bigger question everyone asking in this, how long can the US keeping borrowing like this before global markets start to close fails in the dollar itself? The Fed's big gamble, inflation versus recessions. Now let's move from Congress to Federal Reserve. After nearly 2 years of higher interest rates, inflation in the US has finally cooled down but still above the Fed's 2% target, sitting around 3.1%. At the same time, the job market, once incredibly strong, is the beginning of the stall. Unemployment ticked up to 4.5% last month, and the small businesses are reporting tighter than lending conditions. That puts Fed Chair Jeremy Powell in a difficult position. Cut rates too soon, and you risk reignition's inflation way too long, and you could break economy. It's the ultimate balancing act, and it's getting more political by day by. With the 2026 election cycle heating up, some lawmakers are already pressuring the Fed to do something support growth. But the Powell has made it clear the Fed doesn't take orders from politics. Still, investors know better. Wall Street is reading every single Fed statement like it's a hidden message about when rate cuts might begin. Currently, futures markets are pricing in 25 basis points cut by December, but that could change quickly if inflation spikes again. In the meantime, the effect of high rates bring across the economy. Housing affordability has collapsed, corporate debt refinancing is slowing, and the credit card delinquencies have quietly hit their higher levels since 2008. If the Fed waits too long, we could see a hard landing, a real recession. If it moves too slow, we risk a second wave of inflation. So either way, they might be the most important policy decisions of the decades. The question is, will the Fed cut rates to save the markets or hold firm to protect the dollar's value? Only time and inflation data will tell. China's economic slowdown when the dragon catches up a cold. Let's turn to China, the world's second largest economy. and a key player is more in almost every global supply chain. For years, China was the engine of global growth, but now the engine is sputtering. Recent data shows China's GDP growth dropped below 4%, its weakest performance since the pandemic. The property market remains in crisis. Giant developers like Evergrande and the Country Garden have defaulted on billions in debt, leaving millions of unfinished apartments across the country. Yet unemployment has become a major problem, with an estimated 1 in 4 young people unable to find work. And foreign investors, they are heading for the exits. Over the $50 billion left Chinese equities market this year alone. Why does this matter to the US? Because when China slows down global demand for goods, metals, and energy declines. That means weaker export for the US, lower profit for American companies operating in Asia, and the potentially cheaper commodities price, which sounds good at first, but often signals weaker global growth ahead. It also changed the geopolitical balance. A struggling China might become more aggressive abroad, pushing harder on trade deputies, increasing military presences in South China Sea, and doubling down on its alliance with Russia and the BRICS bloc. In fact, BRICS nations, now including Saudi Arabia and Egypt, are expanding trade in local currency, trying to reduce depend on the US dollars. That's not an immediate rate, but it's long-term shift the US can't ignore. As one analyst recently put it, when the dragons catch a cold, the world sneezes. And right now, that sneeze is starting to echo troubling global markets. So, what's the takeaway from all this? The US is drowning in debt, the Fed is walking the tightrope, and China's slowdown is reshaping the global economy. We are living in a time where politicals and the money are more connected than ever, and even major decisions in Washington, Beijing, or Wall Street can ripple across the world in seconds. For investors, that means volatility isn't back. It's a new normal. The key is staying informed, staying calm, and looking beyond the headlines to see where the real trends is forming. This has been Stockwell's Global Economic Update for October 2025. If you found this report helpful, please like, subscribe, and share your thoughts in the comment below. Which of these stories do you think will have biggest impact on 2026? Thanks for watching, and I'll see you in the next one.